Today on Think Smart with TMFG, Mike and I are going to be discussing, is the U.S. market overvalued? Mike, I read a great article by one of my favorite writers, Ben Carlson, in the middle of November on his blog, A Wealth of Common Sense. And he did a little bit of a deeper dive than we would normally do on market valuations, and I thought we might share that today.
It's been a bit scary, you know. We talk about price to earn ratios all the time. You see it start to go above that 25 level, and that's always one of those signs things are getting expensive. I don't know if it has true meaning, but you feel a little bit uncomfortable.
So one of the things that's happened, we saw leading up to the election that the market was pretty strong.
Yep.
And then Donald Trump got elected, and the market has had another leg to it. It's taken off again, especially the U.S. market. The U.S. dollar has been very strong.
Well, the U.S. market for the last 20 years has almost been an enigma, hasn't it? It's been so strong. We used to always really think that you should balance a portfolio between countries because it gives you a much broader type of rate of return. But the U.S. for the last decade has just gone gangbusters and blew every other market out.
So I guess the first question you want to ask, is it justified?
Yep.
Does it make sense? And that's where we're going to do a little deeper dive than we would typically do into some of the numbers. So what drives stock prices is earnings.
Yep.
And believe it or not, here's the data on earnings for the S&P 500, which are the top 500 companies. Think of them as large companies. It's $235 a share. For the S&P 400, which are more mid-cap companies, it's $175 a share. And finally, for the S&P 600, which are small companies, it's still $78 a share. What's interesting is all three are at or near their highest total ever. So profits are supporting stock prices. Earnings are through the roof.
Well, the U.S. companies, when you look at the U.S. companies we have out there, they're extraordinarily strong. And even though a lot of the manufacturers is done overseas, the profits are falling back to these U.S. companies.
So one of the ways to measure markets is earnings. The other is the price of the stock relative to the earnings. And we talk about that's called the PE ratio. So Ben went and did a look at where's the PE ratio today relative to what's the long-term average. So we'll go to the S&P 500. Right now it's at 21.5. On average, it's 16.5. So it's a little bit higher. And that's for large companies. When we get into the mid-sized companies, it's 16.2. Long-term average is 14.5. So it's slightly above the long-term average,
Yep.
But I would not say it's overvalued. And remember, when we give a long-term average, it typically goes up and down along that long-term average.
Yep.
Right? It's never right on it. It's like rates of return. You never get, the U.S. stock market rarely ever gets the 10%. It's either above it or below it.
Yep.
Same with price to earnings. When we get to small companies, the price to earnings is 15.8. Long-term average is 14.3. So it may be 10% ahead of where it normally is, but it's certainly not overpriced. Only one that you could say was overpriced was large companies.
And that's all those the big 7 or big 8 or whatever you want to call them are eating up that marketplace.
So let's look at a couple of things. Here's sort of the analysis. We talked about earnings, we've talked about prices, but stock prices, the fundamentals have kept up with the rising stock market. And that's not where I would say it's a bubble. Some people are saying, oh, this is another bubble. But if earnings are there, they're justifying the price of stocks.
Well, inflation falls through to earnings, right? I mean, that's why everyone talks about high inflation, but you forget that high inflation means higher revenue for companies, which leads to higher earnings.
Next thing we look at is, well, what do the analysts think? Now, I'm not a big supporter of being able to predict where things are going to go, but it's interesting to see what the analysts are predicting. They're saying that the U.S. stock earnings will go up to 268 on the S&P 500. It's at 235 right now, so it's got some more room to go. Small cap, they're expecting it to go from 175 to 195. They're expecting that to have more room to grow. And finally, that was mid cap. Small cap is going to go from 75 to 89. It's got lots of room to grow. So all three are, again, at or near their highest totals ever, which is justifying the high stock market.
You also have AI in there too, and AI has two things. Number one, AI is a new thing to invest in, and beyond that, it makes companies more profitable, right? We've seen in here, you can use AI can cut down your labor costs tremendously and just make you more efficient, and that's being added onto the stock market and helping to boost profits.
So I talk about that. AI is starting to show up everywhere. I was looking at a PDF today.
Yeah.
And it said, "Oh, do you want to analyze this in more detail? Do you want a short summary of what's in this PDF?" And I clicked, "Yeah, I want a short summary." Literally, it took a full-page document. It shortened it down to a paragraph and a half that completely summarized what the whole document said. All I had to do was click a button. I didn't even need to go into chat. It was built into the program itself.
We continue to become more efficient, which leads to higher profitability.
Let's go back to the question, is the U.S. stock market overvalued? The one area that appears to be overvalued is the big companies, the really big, the monster companies. And if we look at that, the PE ratio of those top 10 companies is nearly 50 times. So we're saying the long-term average is 16. Currently, the market's at 21. These top 10 companies are at 50.
We're looking at the Teslas, the Nvidias, companies like that just have been grown exponentially over the last 4 or 5 years.
So is that real, Mike? What does that typically say? Now, let's look at a price to earnings of 60. So there's 3 companies that are 60 and above. NVIDIA, Tesla, Broadcom, and actually there's 4, Eli Lilly.
I guess the one thing is who you're going to compare them to. Is Tesla going to be compared to Ford, right? Is it a car company? Or has Tesla gone beyond what a car company should be priced at? Because you look at the car company prices, their PA ratio sometimes in 4 or 5 to under 10. And then you go Tesla's trading at, massive price to earner ratio. But maybe some of these companies are misclassified now because as a technology company, it keeps on growing and it's got tremendous potential.
In a previous podcast, we talked about once companies have made it to the top, rarely are they going to stay there.
Yeah.
And what that typically means is they have to have lower returns going forward if they're not going to make it. So I think when you start to see companies that their stock price is through the roof, the future doesn't look good. Now, I don't know what's going to happen in the next 6 months, 12, 18 months. I do know 10 years out, in all likelihood, those stock prices will be less than or only slightly above where they are today.
There will always be competition. Well, we talk about the U.S. stock markets. The U.S. dream is competition. So it's going to compete. And as we said with Tesla and companies like Nvidia, the idea that no one else is going to touch AI over the next 5 years is ridiculous. Someone's going to competition with them.
So the backup question is it a good time to invest? Markets are at an all-time high, which is great. There's still tremendous value in the market. In the U.S. market alone, we talked about how the small companies and mid-sized companies are undervalued. So our strategy with Dimensional of tilting to those small companies could have a really good future over the next few years. The Canadian market is still undervalued. The international markets haven't kept up pace with the U.S. market. They're still undervalued. So there's still lots of opportunity. And with interest rates starting to come down, inflation slowly cooling off a little bit, the future looks pretty good. Once again, are you going to gamble? Are you going to put it all into small companies, Mike? What's our motto? What saves the day?
A balanced portfolio at all times.
Diversification, right? So balancing that portfolio, taking profits from the area that have done well, that's what will deliver the best return over time. That brings us to the end of another week. This is Rob and Mike with Think Smart with TMFG from the McClelland Financial Group.